been at Canfax for about 5 years now, and certainly been a pretty exciting time in the beef industry. Things still definitely very, very strong, but maybe some tone changes out there in terms of, pretty much steadily thinking prices will go higher and higher, but we might have to readjust our expectations here now. Had some pretty major rallies and been through a pretty big correction too. And luckily in Canada, I think I've seen the sort of headlines, it could be worse, and I think that's certainly the case. And we'll go over what the factors that we're watching and where we take some stabs at where we can think we might be headed here. Today's talk too, also kind of thinking and talking about beefing up the herd and expansion, and I think no surprise at these prices and profitability levels we might have some incentive to expand. So talk about what to consider when looking at that. But first of all, what's the beef industry all about? And this guy, I just think that summarizes it quite well in terms of how the cattle industry works and where our advantages and disadvantages are compared to our competitors. And realistically, we compete globally with other beef producing countries, but we also got to compete pretty aggressively with poultry and pork. And we use different resources, have some cost disadvantages, but we also have some price premiums that we enjoy as a product that we produce, and that ultimately determines where the industry goes and how producers react. So thinking about just some food for thought here before we get into more market analysis. Are you ready? Ranchers have become very accustomed to managing in the tough times. And, managing the good times is just as important, and sometimes a little new uncharted territory is, if we've got money to invest and where to invest it, and in deciding on how you want to shape your operation going forward. So, ultimately the strength of your operation and your ability to weather the next tough times will truly determine your success. Now, tough times will be different for different people, and depending how you set your farm up. Because again, if you think about where's your mindset, I can't believe, or can you believe calves are over $2? A couple of years ago, $2 calves seemed to be that target that everybody wanted, and we blew through $2, hit $3. So, where's your mindset? Can you believe calves are $2? Or, are we going to be going down the road, or are you setting yourself up saying, well, what are we going to do? Calves are only $2 a pound. How are we going to be successful, or how are we going to make it? It's all how you structure your farm and your investments. So those are the kind of things you want to think about when you're making your investments or looking at expansion. What kind of price levels can you sustain, and where your profit levels stand? So in terms of the expansion, obviously there's two questions or two answers. You're going to expand, or you're not going to expand, or you're thinking about expanding. But if you're not looking to expand, depending on your operation or your stage of life or your family involvement, so you can still stay in the industry, maintain the herd, enjoy the good times. You can sell the herd, liquidate it, or wind down slowly. Nonetheless, there's different ways of how you want to go through these next few years, even if you're not planning to expand. If you're looking to expand, again, how retaining heifers, buying heifers, leasing some cows or leasing some animals, custom feeding cattle to complement your operation. Lots of ways to expand without necessarily needing the big capital outlay. And ultimately, again, if you're yes, it's, these are investments. These are dollars you've got to put into the operation. Are you investing wisely? Does it improve efficiency, lower costs, increase profits? What's this dollars that you're going to expand with? Where's it going? And what's going to be the ROI, the return on investment of this money when you're looking to expand the herd? So with that to chew on as we go through some of these, today I just talk about a little bit quickly on international markets, some fundamentals, Canadian markets, supplies, expansion factors, the quiz, which you'll all pass, so don't worry. International markets. So ultimately, we've been talking about shrinking cattle numbers in North America for quite a long time. The U.S. has been on a long-term downtrend of shrinking cattle numbers. But it's not just North America. Globally, these are just showing annual numbers of beef, pork, and poultry back from 2009 to 15. And basically, beef hasn't changed. It's a very large, land-intensive crop or whatever, livestock production system. So it's not easy to expand into countries Where they are growing economies wanting more wealth, they're going to demand more beef or more pork and broiler meat initially as they introduce meat to their diets, and ultimately they'll get to beef. But those other countries that have a growing demand for animal proteins are expanding their pork and broiler operations because they can, even if they don't have the feed there, they can import the feed and produce the meat. Where beef, it's just takes a lot of resources and land that some of these countries don't have. So really puts Canada well positioned, and it was a big reason for the big boost in beef prices last year. And just to show kind of where wealth, if you look at China as one of the fastest growing middle classes in the world, 300 million middle class people potentially by 2020. They're going to start wanting to eat more like a North American diet and demanding more beef. And ultimately, as you've seen, with supplies pretty flat, they're not, there's some countries trying to expand beef production, but it's been slow and difficult. Still bodes very well for beef demand. It's driven really, it's not about the currencies or about population. We hear that a lot, we got to feed 9 billion people by 2050. Unfortunately, the reality is if we put another billion people, poor people on the world, they're not going to afford beef and it's not going to affect our demand. So it's really about wealth, not population. Just to put into perspective in terms of what the values are export-wise, these are just showing, Canadian exports over the last 15 years. They are shrinking, but again, we're not producing nearly the beef we were, so obviously we're going to have shrinking beef supplies. And beef to export. We still consume the bulk of our beef here in Canada. But ultimately, if you look at 2015, we were projecting to export about the same amount of beef as the last year, but the export value is going to be up about 20%. So, that's just almost a direct 20% increase in prices. In addition, in 2014, we did increase exports maybe about 15% from 13 to 14, but we exported the value went up about 45%, 40%. So we're talking 50-60% increase in export value on very limited export growth. So these prices are strong for all types of different products. And we really gain a lot of export value through exporting the stuff we don't even want to eat. We ship livers and tongues and all those. Maybe they're the good things depending what your tastes are. But, Peru and Japan takes the tongues, and all those little countries add a few dollars on every head that add a few cents to the pound of our calves. And the big thing is demand. Again, as I said, we've been talking about tight cattle supplies for quite a long time. We've kind of been bullish on these markets, thinking, prices will go up. I don't think last year we were near bullish enough when we talked, who would have thought 3.25 6-weight steers earlier this year. Phenomenal prices, and ultimately the supply kind of gives you a direction trend, but it's the demand that's going to say what kind of magnitude change in prices are we going to see, and that's where we saw both globally and North America. Talk about consumption falling, per capita consumption's dropping, and it is. We don't have as much beef around to feed everyone, but if we're making them pay more dollars to eat less beef, it's not all a bad story, and certainly demand has been strong. Ultimately, and the test is really yet to come when we're going to start introducing more beef to consumers at these elevated prices. Are we going to be able to maintain prices? And then we'll test demand. So looking at the U.S. numbers, obviously they're the driver. They produce almost 10 times as much beef as Canada does. So what they do, we follow. In terms of prices, the industries might move a little bit differently. So those purple bars, that's U.S. herds, and I think probably 17 or 16 of the last 19 years, I think, is a shrinking cattle number. So supplies have dropped. You will see, though, they have started a slight expansion. So they are going to see a few more cows coming down there. And the U.S. Is going to have more cattle around next year. What we didn't, or what's often not talked about, is production. The black line higher up showing about 24 to 25, 26 billion pounds of beef the U.S. produces every year. But for several years, or many of those years, except for maybe 03, that BSE kind of hiccup in 04, their beef production stayed very flat. So they were basically, they were eating the factory in my mind. They were eating cows. Heifers were being sent to feed versus getting kept in the herd. And we were able to maintain beef supplies through those shrinking times. But when the switch kind of finally turned in 2014, you see we dropped 5-6%, and that line, we are going to be lower in 2015 for beef production. When you have the smallest calf crop in 60 years, you want to expand heifers, your cow culling rate drops 20%. All of that just shrinks your beef supplies in the short term. And that's exactly what happened last year, and we saw the prices react. But that said, with the this year's production being down, I think there's potentially another 1 million head of cattle down in the United States that could be available for slaughter next year. Maybe later in the year, and probably not all going to come next year, but there's more cattle around. So basically, one of the key points here, without a big weather change or something, we're likely seeing some of the tightest beef supplies for the next little while anyway. So from a supply standpoint, we might have hit that point or that low for the short term anyways. And it's weather driven. The US, actually, they've had some pretty good years down there, but they had some horrible droughts in 2011, 2012. They've been suffering drought areas in a lot of parts of the US. And the big areas for their cattle numbers, Texas, Oklahoma, New Mexico, and Kansas. Those 4 states in the south had some terrible droughts, and those 4 states have about 8 million beef cows. So to all of Canada has less than 4 million beef cows. So they had a massive sell-off, you give them a bunch of rain, they're going to put cows back and be demanding cattle and feeders. So hence they're not in a full big expansion mode, they're into a recovery phase, but nonetheless there will be more cattle. So what's going on in the markets? Where do we look, or where do I look? One of the first things is always looking at the futures markets. Looking the last 2 days hasn't been very friendly. Yesterday was limit down, and today's got a kind of an ugly start. But some of the price direction isn't all that positive. As I said, the futures market, it's an anticipatory market. It's kind of trying to project based on what we know today, what do we think prices are going to do. But if you kind of step back, obviously we've been on about a 5-year run of good times from prices that have been on a rally. But that uptrend broke earlier this summer, and right before the fall run, fed cattle prices in the US dropped like $20, $30 in a pretty short time frame. And if you actually look at the futures, they peaked last November. So we were kind of, that's when the expansion started to show up. There was more feeders around in the US. So they've actually been downtrending for almost a year. We kind of hope this uptrend will continue, but when it breaks through that, technically that's a bit concerning. And we did have a pretty good correction, but as I said, we're kind of heading back down. So technically, as you keep this in mind, we are in a downtrending market in a broader kind of scope. Still pretty strong. The other thing I do like to point out, 2014 isn't great of a rally it was. We're actually quite a bit lower than a year ago. So prices are below a year ago if you put it in US perspective. And obviously in Canada, we got the Canadian dollar, which really saved our butt this year in terms of where our prices are relative to theirs, and I'll talk about that some more. Canadian market, again, we've had a tremendous run in the last few months, or even a year, call it 2 years. But overall, we've kind of been trending higher for 5 years as well. Similar kind of graph as the United States. But $2 calves sort of seem to be the target. And then this summer, we were selling fed cattle for $2 a pound. So, take a 1,500 pound steer at $2 a pound, that's $3,000. So big money involved in the industry now. And at all stages, everything's gone up. Calves and feeders over $3. They've come down as well. They've been under some pressure. This is a monthly chart, but we still got 550 weights at, what are we, 280, 285, maybe down a little bit this week. But nonetheless, extremely strong compared to where we were 3 years ago. $1 higher than 3 years ago. But we are, nip and tuck, maybe a little lower than a year ago as well here in Canada now. And again, the biggest market factor truly in Canada has been the Canadian dollar. The Canadian dollar's added by far more value to our industry than anything else has this year. So, it's certainly took out as well. If you look historically, 2009 had a pretty big low, and we're at the lowest dollar we've seen in nearly a decade, or over a decade actually, 2004. I'm not sure, oil prices, depending what you think, they're still a big driver in our economy relative to the US. I'm not totally sold it's been to hit the low yet in terms of, it seems 70 cents might be a low-end target and seems to be kind of resistance at 78, 80. But still, that's a 10-cent range, 70 to 80 cents. But it's tough enough calling cattle markets, never mind trying to predict the dollar. So anyways, we'll just leave it at that. And just to put into perspective of what the dollar's done, and I usually don't do this, but just to be sure, the red line is the U.S. price of a 550-pound steer. So the average price of a 550-pound steer in the United States in U.S. dollars, and the black line is 550-pound steers in Alberta in Canadian dollars. So we usually always compare same dollars. But just see, it's rather interesting, and it's quite an anomaly that they've actually tracked so closely. Our dollar was a little lower, but we're always at a discount to their prices. So it's usually, if you take the U.S. price, adjust it for the Canadian dollar, and take off transportation, that's kind of the long-term average of our prices. So we were maybe a 92-cent dollar or 90, and fluctuated through there. That kind of offset the transportation costs, kept our prices the same. But ultimately, again, the U.S. prices have been under tremendous pressure, where we continued to rally into 15 and are just now starting to come off. But again, if you follow the U.S. side, there's potentially a little bit of pressure there. Nonetheless, we'll talk. That's pretty much killed any exports going south too. That the fact that it's not really that the dollar's cheaper, but their prices have fallen so much more. Retail prices, are obviously, at the end of the day, every dollar that a cow-calf producer gets originates from a consumer. You can't forget that. If the consumers aren't going to buy beef, there's going to be nobody to buy your cattle. So, they've got to pay up, and, we've certainly pushed prices up the chain, and it isn't a direct relationship, but it takes time. Retailers don't bump prices overnight, and plus, a lot of their products booked, could be 6 months or more in advance, so they don't have to adjust and react. But, they've got to watch consumer sensitivity to changing prices. But nonetheless, we've seen pork prices and cattle prices both went up very, very quickly. Poultry's just struggled, period, in terms of their demand. But nonetheless, we've seen pork prices come off tremendously, and beef prices have started to flatten out. So it's been a bit of a good story and a bad news story in terms of the retailers now. We've seen prices in cattle and wholesale beef drop off. Retail prices haven't really reacted. Retailers are trying to take back some of the margin they lost. Cheaper pork is kind of competing with our beef prices. But by not reducing the retail prices, we haven't seen the consumer demand come back to pull out the pipeline of beef. And ultimately, as the prices come down, we start to see more featuring probably this fourth quarter. You'll probably see some features on the paper. Although I don't know, I'm in Airdrie. That's where I live. I know I'm in Olds, but we're in Airdrie where we live. So I've been on the road lots this week. But anyways, I saw on the front page of Walmart and No Frills had a special, $2.97 a pound. They kind of call it ground beef, but it's actually 60% ground beef, 40% pork. Not necessarily the kind of thing I like to see, but it's kind of concerning when we get our prices that far out of line. When we had wholesale prices almost 4 times beef, they're going to try and find a way to cheapen it up. So I'm hoping it doesn't taste very good, but I should go try some. But anyways, these kind of dynamics, they can't go too far out of whack. But both of them, sort of interesting, both on the exact same day had that front page. We'd heard about it, but I guess it's out there. So that, in a way, that kind of puts a little bit of a potential cap on our prices too. The other thing, just in terms of the retail side of it, this is consumer price index. So just basically, this is the inflation rate from back to 1980, and everything's indexed at 100%. So putting everything in 1980 dollars, since then, inflation's up almost 300%. Where you can see beef prices have been below it. So basically, beef prices have been going up slower than inflation. Not a big surprise. It's been a lot of media this last year, do quite a bit of questions from media, whether it's TV and news and stuff. What's happening with beef prices? All they care about, what's beef going to be for grilling season or whatever. But we just keep pushing the story. Prices are going to be high. Producers have been liquidating herds, expect to pay more money for beef. And I don't think that's a bad thing to put out there. It's reality. But on the other terms, we've just caught up to inflation. We're not, it's not like consumers are spending massive amounts. They might have to cut back on a cell phone bill or something else. But it's not a huge thing that's going to hurt them too bad. And my feeling is, we're probably even going to come back and where that inflation and beef prices will moderate, and we could even see beef go below inflation again. But it's just good to put that in mind. Cull cow prices, again, they've highly tracked the US. These are put in the same, these are in Canadian dollar terms, but again, we're seeing some pressure there. Again, we've actually seen our cull cow prices come off quite hard, but that 90% trim market, which is really what drives cow prices, you know, blending it off with pork doesn't help. We've imported a lot of beef as well, that manufacturing beef from Australia and New Zealand. Those kind of factors, you know, you get high prices, you know, the cure for high prices is high prices. Again, not looking for devastating lows, but you know, we're seeing lots of cull cows closer to $1 and $1.05. And again, all these prices do move in tandem. We look at retail prices, cattle prices. This is wholesale prices. Alberta, here's the live price of a fed steer, and here's the cutout price. So once you take that steer and put them into a box, you know, what's the weighted average of that animal? And they obviously going to track together. You know, again, steer prices got a little higher relative to cutouts, and again, that's basically not enough cattle around. Packers are fighting for cattle and willing to sacrifice margin to fill orders. The other thing I'd touch on is call it the fifth quarter, or all the byproducts, hides and all those other organ meats and blood and bone meal, all of those things, those can add up to quite a few dollars a head, you know, pushing almost $180 plus at a peak time for all those other products that, you know, we don't think about very much. But we've seen quite a lot of that price come down. Hides are off, you know, $10, $20 from peaks, and a lot of those different products are not, and this is more US. Canada hasn't come off as much because of our dollar. We export most of that stuff. But again, in terms of overall value, in the US, they've lost $6, $5, $6 a hundredweight just due to all those byproducts going down in value. So if we think, you know, fat prices should be $5, $6 more, it's purely due to byproduct value loss. So just some things in turning on the beef industry, and hopefully those are going to bottom as well and find support. So through all this, in terms of profitability levels, ultimately we've been talking about record high prices for about 3 years, but you know, it was no fun being a feedlot back then. They were still, you know, having a hard time making any money. And you got to remember, all of this chart then, again, profits were very strong, and now we've seen pressure again. When the markets shift like that, they've bought record high prices, and now they're selling them, you know, quite a bit lower than they were expecting to. But again, this assumes no risk management. So they bought the calves, bought the feed, and sold the cattle on the cash market. There's a lot of opportunities to contract offset this risk, which some guys did, but they also capped a lot of those profits. You know, guys were delivering cattle and might have had a $50 profit that, you know, if they weren't contract, could have made $600. So there's a huge variation in there, but again, those guys' long-term averages, again, just get a steady return on investment is their goal, and if they're doing that, that's great. But nonetheless, this shift here in profitability, and that came into the U.S. market much earlier than Canada, through earlier in 2015. So again, if the feedlots aren't making big dollars, they're not going to pay as much for calves, and that's part of the pressure as well on our calf markets. And basis levels, you know, on top of when we started getting these record high prices, you know, the pork industry was struggling as well last year with their PED virus, and, you know, feed costs were coming down, our dollar was coming down. Everything was pretty much perfect. What could get better? And, you know, throw in a $20, $30 basis shift. Basically, basis is comparing Canada prices to US prices in simple terms, or the futures market. And generally, as I said, we're almost always a discount. We're 99.9% of the time, we're at a discount to US prices. Throw in, you know, this summer when we went $15, $20 premium to the United States. So that was huge. So on top, hence why, again, Canada's had a lot better run than the US producers. And again, part of the reason last year in the fall of 2014, we exported piles of feeders. We exported a lot of feeders in the spring of 15. Packers here didn't have cattle, basically, and they had to buy, again, fill orders, compete. We even still saw a little bit of U.S. packer interest out of the Northwest. So again, that added a lot of dollars to our market while the U.S. was sort of struggling. In terms of other input factors, you know, cattle supplies and the dollar, you know, feed is ultimately one of the biggest, or the biggest input cost. And again, big U.S. corn crops, you know, they had some pretty big had some advantages last year, hence we sold cattle south Cattle move south based on basis levels and feed costs. The Canadian dollar really has nothing to do with it, and we'll see here coming up. But again, big grain crops has been supportive. Big reason they've seen part of the growth is ethanol demand. But ethanol demand burns about a little over 5 billion bushels a year. So, if they're producing 13.5 this year, but they've been at 5 billion for a few years. So again, they've got more and more grain that can be used for residual uses, and that's seen some pressure in corn prices. On the other hand, this is sort of the concerning side, is the longer term trend in barley is pretty much the exact opposite and struggling. So if we want a competitive feedlot industry, a competitive industry overall, we need competitive feed grains or feed costs. And this trend isn't too concerning. We've been managing quite well. The dollar does affect U.S. corn prices in Canadian dollar terms is a little bit higher. So that offsets it. We've been feeding wheat and other things, but as a long-term trend, we're going to need some a grain, and it very well may be corn in terms of growing more corn. In southern Alberta or Manitoba's growing corn, and there's more guys growing in the south for grain now rather than just silage. So maybe that's it, but just something to be aware of. Hay prices have been very high. Obviously, the dry conditions this year, obviously shorting the hay market, and seeing a big demand for hay. Obviously, with the price of calves, the guys have been willing to pay up, but it has cut into the bottom line. Or, again, look for alternative feed sources. Hay is one of the most expensive out there. Another thing I'll just point out in order to throw this in, but changing marketing patterns. How do you, again, being proactive in these markets? Prices are changing so fast. The markets are so volatile. It gives some opportunities for guys marketing cattle though as well. And we saw some guys do it this year. We saw some guys do it last year where guys, and what this is showing, these are the monthly electronic volumes. So you take like DLMS, Team, and other private satellite sales and internet sales that guys are doing. So we collect those volumes every week. But you can see here, we do get a bit of a spike in the fall, but here this September was phenomenal. Over 90,000 head sold on electronic sales, and most of those were calves selling for October, November delivery. So finally, we're getting guys sort of removing themselves from the process of just hauling and delivering calves and selling them to marketing them when the market signals are there and delivering them whenever it suits them, them and the buyer. So, there's some big price signals. Last year, again, guys did it. They sold early. Prices were record high, and yeah, they lost out on a few bucks for sure. This year, again, on guys who stuck to a strategy or a system, made out big time. They could have made $200-300 more probably on those calves than what we're seeing today. So it's not always a win-win, but it's just the ability to sell cattle ahead of time. You list them, you have the option of saying no as they go through, but we are seeing more and more of this coordination through the supply chain, whether it's that or even just direct sales and contracts of feeders and such. So marketing has changed a bit that way. Canadian-wise, the industry is consolidating here. This is 2001 census, probably still where we have still shrunk since then, but I'm not sure these ratios will change much. But we had about almost over 60% of our producers had less than 48 cows. But those same producers only accounted for less than 20% of the cow numbers. Meanwhile, only 3% of the producers had over 272 cows, but they controlled almost a quarter of the cattle herd. So again, those guys are certainly the ones probably that are going to make the biggest change. I think if we talk about expansion, it's coming from the bigger producers. It seems to be these days. Traditionally we had lots of smaller mixed farms, but we've got such large grain farms these days that a few cows is just a pain. And doesn't really offset from a risk management point of view unless you get large into cows as well. So nonetheless, I think that consolidation is going to continue and see more larger herds. New entrants, traditionally new entrants or everybody expanding 10 or 20 heifers just doesn't seem to be happening or be enough to expand because we're not expanding. Basically, our cattle inventories are still dropping. This is as of 2015. Partly we exported a whole pile of feeders. So this is total cattle numbers, which, I watch. Obviously we follow, but we ultimately want to know where the cow numbers are going because that's going to determine the future a little more. But nonetheless, cattle numbers dropping. Cow numbers did have a pretty significant fall through 2014 in the first half of 15. So we've lost 30% of our cows, and Alberta was down quite a lot as well. So again, unfortunately, despite the price signals out there and the profitability, the producers have still been pretty cautious. And ultimately, the biggest driver to expansion is keeping heifers. We might have our cow marketings might be down quite a lot this year, but if you're not keeping heifers, you can't expand the herd. And I think weather came into this. Obviously, I think anecdotally, there seem to be more guys willing to put heifers out and keep some heifers back, but they just didn't show up. A lot of them went to town early or didn't even go to grass or could have gone to the U.S. So we haven't seen the expansion come through, and hence why we're saying, we're not expanding in 2015 yet either. We've got to keep, we're at 600,000. We should be at least a couple 100,000 heifers more. So that's a pretty big chunk of cattle numbers too. That ultimately could short cattle supplies. We slaughtered over 2 million fed cattle. So, a couple 100,000 less, that's 10%. Just really rough math. But it's still a significant number of cattle that need to hopefully transfer over to the cow herd. And just showing the map earlier in the year, this end of May, but when guys are looking at going out to pasture, it didn't look pretty bleak in a big part of where the cattle numbers are. Western Canada has about 87% of the cow herd. And despite, I said culling rates are down, we're not culling as many cows, but we're still not, into big expansion numbers. We're still probably culling 11% of our herd, just sort of a steady as you go number. But with those really small heifer retention numbers, it's not enough to grow. And finally, feeder exports, kind of touched on that. Despite our dollar being down in 76 cents, it has nothing to do, or really doesn't affect exports much. It's feed costs, basis levels have been strong here. Like I said, our prices are premium, even in Canadian dollars, or, they're not going to go south. Feed costs have been competitive. So that does mean, maybe we'll have a few more cattle around in Canada. Not going to be cows, but we'll have some more cattle, which still bodes well for feedlots and the packing sector. Thinking back to that basis chart, which was sort of another outstanding part of this whole rally, I think basis levels may come off a little bit. A lot of the feedlots, when they go to buy a calf, they're going to look at the futures and the dollar, and then what's the packer offering for a basis level. That's when they're going to figure out what they can afford to pay for a calf. And packers, they don't need to be, basically the cattle are staying in Canada, the basis weakens. That comes out of the cow-calf producer's pocket too. A weak basis, means lower calf prices, generally, all else considered equal. Just another chart, a real complicated chart to make a real simple point, but that's what we like to do. Anyway, Western Canadian slaughter down about 7% year to date. So slaughter plants, with all those exports going south and early in 14, or late 14, early 15, there hasn't been the cattle around, hence our basis were strong. But keep in mind, what's the easiest and probably the best way that the cattle industry's adjusted to small numbers is to grow them bigger. You got less cattle, grow them bigger. And, we've done that in spades. You look at those fed steers, the average carcass weight in Canada is about over 930 pounds. That's the average carcass weight of every steer slaughtered in Canada. So these are monster cattle. We keep talking about carcass weight's too big, but we just keep making them bigger anyways. And that's all the market incentives are there. If you look at the cost of production on fed steers, the last few pounds, even if it's costing you, just pick a number, $1.30 or whatever your cattle are doing. If you're selling it for $2 or $1.70, every pound you're getting paid for, you're making money on, as long as the packers aren't discounting it. When they're super short cattle, they're not going to discount the big carcasses. It's cheaper to put on the weight than buy in. You could put on weight on cattle you had or sell them and then go buy calves. That was pretty high risk. And ultimately through this rally, the longer you held cattle, the more they went up in price. So it was just growing them bigger and bigger. And the genetics are there, so we can push all parts of the supply chain and I guess see how efficient we can become. So nonetheless, these bigger carcass weights, that's adding about 4% to our beef supplies. So despite slaughter being down 7%, that's more than half of offset just in bigger carcasses. And going forward, I don't know if we're going to continue to increase, and we may see carcass weights come off, or they will seasonally come off. They're near the peak, but nonetheless, the long-term trend, you think about expansion, we can produce less beef or more beef with less cattle. So expansion considerations. Obviously, cow-calf producers, best positioned, we've kind of been fairly, that's been fairly confident. You got very strong demand and tight supplies. All that does transfer into higher calf price. Everybody's competing to get the meat, to get the cattle, and the cow-calf producers kind of control that. It's almost unfortunate. It just dwarfs the tough times we've been through, but these tough times, I think, still are playing into how I think producers are reacting to this recent rally in terms of just the caution out there and whether they believe it or not, or are willing to go and invest in a $2,500 bred cow knowing what they've seen and been through before. So I think that's affecting the expansion side of things. The cow-calf producer, again, showing on that chart, depending when guys sold, they could have sold their calves for a couple $100 higher than a year ago, or $300 or more higher than a year ago, or they could be selling them for less than a year ago. But nonetheless, profitable, give or take close to a year ago kind of profit levels. And again, looking at long-term charts, where do we think we're going? And ultimately, you got this kind of, might look, have we been here before? Might be the oddest question you've seen on this scene yet. But if you look at the chart, if you kind of pretend this part isn't here and you go back a long ways, but late 70s, early 80s, back here, we did double in about 3 years. Fed cattle prices doubled in 3 years. Some similar ideas to what we've been through. Very big tightening in cattle numbers, cow supplies tightened up, all that sort of thing. Some similar conditions. We doubled up, and we kind of started trading into a higher kind of trading range. But at the end of the day, we doubled our prices, and we gave about half of that rally back. So we went from $40 to $80, and we went to $60. We rallied $40, and we gave half the rally back and actually went lower. If you look back here, we went from $80 to $160, $170, same kind of idea. We doubled, and we've given half the rally back. Out of this time we rallied 80 and gave away $40, and hopefully, and it seems to be some more equilibrium here in terms of pork and beef prices have kind of realigned. Supplies are going to be coming on, so you don't want to. I think basically in terms of expectations, we don't expect this trend to keep going in the short term by any means. Probably have hit the highs in prices, the lows in supplies. Competing meats are strong. Now it's all about finding value, and there should be some technical support in here. So are we into a newer trading range? Probably, but saying new normal is dangerous, especially if you get into a situation like that where those prices may be a kind of a longer term peak. So here's taking a stab in the dark, and I'll stick my neck out, and I'm not sure I could make a slide that has more assumptions on it than this, but just to help. Or how I looked at it, or give some methodology or systems behind. How do you figure out what to pay for a bred heifer? So basically, this is called just using a net present value assessment. Basically, you're going to go buy a heifer. What's the cash flow going to be? How much are you going to make every year, and what's it going to cost you every year to keep this heifer? And then you want a return on investment. Obviously, it's a risky investment. I've plugged in 5. That might be even low, probably, if you're going to take on this kind of risk, what kind of return on investment you want to make it. But anyway, these are the assumptions I've used. So a big part comes to what's it going to cost you, and you got to think over the life of this cow. So again, we're taking some stabs at the dark. Our hay price is going to come back down, or we change our feeding system. However you're going to do it. So this, on scenario 1, say production costs $750 a cow. First calf she's going to wean will weigh 500 pounds. Then the rest of her life will be 550. And remember, these are average weaning weights for the herd. So these are steers, heifers, every calf. This isn't just your prime steers or anything. She's not going to have steers all the time for sure. So these all got to be averages of your entire calf crop. And same with these prices going forward. So you can see I've moderated them. But again, these are just the best dart throw I had at that time. But so these are the long-term average on steers and heifers. Again, these aren't just your steers, so you got to keep that in mind. There's some pretty big spreads these days. Salvage value, and then just a culling rate, death loss on cows and calves, and basically what do you think you can pay? So with those assumptions, it works out you can pay $2,425 for a bred heifer. to get a 5% rate of return under those assumptions. Again, just a slightly different scenario in terms of a little lower cost, a little higher prices, salvage value down a bit, but nonetheless, that's $3,000 bred heifer. And finally, and I think this one even jumped at me, if you're setting up your costs, and as I kind of started, cost of production is key, and when you're investing and spending money, we do get a little carried away. We saw it in the early 2000s when producers, I think, and I was there, our farm was there, in terms of being complacent. We had the low dollar, high prices, lots of profit. BSE hit, and probably the industry did a great job shaving a couple $100 or more cost of production off their cow herd. But again, just a risk I maybe see. We're going to start getting higher cost structures in our operation, but $950 annual cost, and depending on feed costs and how you feed. Sort of moderate in between, a little bit lower prices, salvage. Basically, that works out to $1,100 is all you could pay for a bred heifer. So good luck finding an $1,100 bred heifer. They're gone to the feeding sector, and I think this is what this also illustrates, even some of these numbers. You tweak this a little bit and you're pushing $2,000, you're pushing feeder price. And that's really stamped into our ability or willingness to expand. Because guys are like, I don't know if I want to spend that much on a bred heifer. Well, next thing you know, the feedlot's bottom and they're going on feed. So it's looking like a slow expansion. But again, it's super important. And again, you play with assumptions, but it's a net present value is what I've used here. Looking at it another way, bred cow price is a percent of 550-pound steers. Basically, if you take a 550-pound steer, and again, simple math, let's just say they're worth $1,600, they're probably worth a little more. But on an annual average, so if the average bred cow is 1.5 times a steer price, $1,600 steer, 1.5 times that's $2,400. So that was planned quite that perfectly, but nonetheless, it kind of comes in line as to where cattle prices are. For some selling bred cattle, $2,400 is probably disappointing, especially if you tried to buy heifers and breed them and all the other thing. And again, our guys going to be willing to try again next year to expand the herd. We'll see how bred prices come this fall. I think they might pick up a little bit, but with high price feed, we're not probably going to shoot the lights out, and with sort of a little bit of a more cautious or negative tone in the market, don't see a huge upside to the bred market this fall, I guess, in my mind. And tame hay acres, we talk about feed, and ultimately we're competing with pork and poultry from a meat side of things, but we also got to find the land. We've had tame hay acres drop off as well. We've lost over 1 million acres there. We haven't lost them. They just all of a sudden got broke up and turned yellow, and we know where they are. But if we're, going to have competitively priced feed, we need the acres around, and we've lost some of that. And it's going to take, again, that transition. The U.S., a little bit different. They just had, no grass, no rain. Took the cows off, it rained, they had the grass back, and they're expanding. We've got to go, basically kind of compete for some of this land or make use of some land that's maybe no longer fenced and all the other stuff. So key factors to watch, world supply and demand does remain very supportive. There's always global uncertainty and all that sort of stuff. But realistically, we're not seeing a lot of expansion going on globally. Australia's been through a wild ride. They're the biggest source of imports from outside of North America is Australia. Their herd has gone from a 30-year high to a 20-year low in probably less than 3 years. So that's a pile of cattle they've worked through. So, their supplies, they cannot keep producing and exporting the beef at this pace. So, that's maybe also positive. And they've been shipping a lot of beef to China and other countries. So, world globally, it looks pretty good. Cattle prices remain historically high. I put those projections up there. Could be all over the map. I'm pretty safe, historically high. I can cover my butt because we don't have much history at $2 plus calves, so we can still drop quite a ways and remain historically high. So I'm feeling pretty safe there, but nonetheless, cow-calf production, profitability should be pretty good, assuming, you're managing costs. It's going to be 3 to 5 years before expansion sets in. That's more Canadian-based, which, maybe not quite as relevant as the U.S., because like I said, they've got more cattle around and going to see more beef supplies. This market tone down there is interesting to watch too. I don't know, their expansion's probably going to slow. There's guys that paid huge dollars down there for breeding stock. That trend and change in prices, they're maybe not looking so smart or feeling so confident, we should say. could slow expansion, but they'll probably still expand some more. And the beef prices reacting with increasing supplies. It's been easy. We've been forcing or pushing prices higher through the supply chain because supplies aren't there. Again, they've gone up quickly with tight supplies. How fast are they going to come down with increasing supplies? Again, globally could swallow that all up, but again, we're still going to have to play with that. But it's a little bit, it's not going to go higher. Going to be pretty tough to go higher in the short term. Is Canada competitive? And it's sort of a two-edged sword because, tight or shrinking numbers, is from a producer point of view. If you have the cows and the calves, that's good. You've got less competition for calves. From an industry point of view, we've got we still have to maintain some critical mass of our packers, our feedlots, and all the suppliers in there. So, are we going to maintain our competitiveness at all of those different levels of the supply chain? And ultimately, are you competitive? It's really the biggest driver. How much more profitable are you, I guess? And how much of a premium can beef maintain? We've seen some crazy spikes in beef prices, and ultimately we do have a higher cost structure in producing beef. We know that we've got to live with that. Generally our wholesale prices are, between 2 to 3 times higher than pork. At times they're 4 times higher through all this, but right now we're back, and we've come back, a couple months ago we were about 2.5 times, back to kind of close to average. Problem is pork prices have been on a pretty big slide, so that's a bit negative. It was nice we came back in the line and our prices were still good, but if pork continues to slide, beef's got a challenge. The indicators for expansion, I think we've covered this. Profitability. Just to cover the dollar. I can't stress the dollar enough, and with these high futures prices, when we see these shifts in the dollar, it has a bigger impact on calves. And when the futures, especially when they were like $1.60, they're only maybe close to $1.40. But when futures are about $1.60, a 1 cent change in the Canadian dollar adds or subtracts 5 cents from calf prices, holding everything else constant. So, and that's on like a 550 weight steer. On a yearling 900 pounder, it'd probably be closer to 3 cents. But if you think about the dollar, it's 76 cents today. By next fall, let's say if it goes back to 86 cents, keep everything constant, that's 50 cents off our calf prices. So if you think 280 for 5 weights, you're down to 230, just like that. And again, that's why I say this year could be a lot worse. U.S. calf prices are at $2, right? They've come all the way down, and our dollar's really saved us. Not to say it's going to 86. On the other hand, we're 76, you go to 70 cents, that's 6 cents, add 30 cents to our price of calves, so we're back over $3. So hugely volatile, that's a huge range, but nonetheless, it's the biggest market factor to watch here, I think. Or one of them. You've got to watch it as closely, if not more, than the cattle markets. Especially if you're marketing cattle, you can check the futures. You get other guys that only check the dollar and don't check the futures. You got to check both. And then feed supplies, we've talked about feed costs, barley, grain, hay, labor, other, resource availability. And demand pull opportunities. We're going to talk about, you'll hear about social license, and there's all sorts of different opinions, and we've all probably cringed at a lot of different things. But, when you talk about demand, we've pushed prices higher through the supply chain through all of this. But ultimately, there's all sorts of consumers out there. How do we drive demand and meet these kind of different demand scenarios that food service and retailers are pushing around? Basically, it's what's happening, and on the other hand, we might not like a lot of it, but there's probably any challenge always comes opportunities. And trade opportunities to maximize value is huge. If we look at the TPP in Japan, every piece of beef, they're our 4th biggest export market, yet they tariff us at 40%, 38.5%. But if you start taking some of that off, what's the opportunity to potentially double exports or things like that to those kind of countries? Country of origin labeling we're still dealing with. We still can't to this date export beef from cows over 30 months of age to Mexico. That's a BSE thing from 12 years ago, and we're still kind of hindered by that. And they were quite a big buyer of white fat cow meat. So, there's still more to come, more opportunities to add value. And other products. So finally, expansion, what will it take? Confidence in these kind of prices to make that investment. Land reallocation, capital. It takes quite a few dollars now. When heifers were $1,100 versus being 2,500 or more. And rethinking the model. There's a lot of ways to run an operation, and first a lot of guys will say, well, if you buy the land, buy the cows, and buy the equipment, it doesn't work. But reality, yeah, it's pretty tough. It's probably always been tough to do that in agriculture. It's not a new thing today. But there's guys out there that start with a quarter or two and can build a pretty big operation on a very small land base, even cow numbers. There's enough dollars in the system today that it could have a person owning cattle, making their desired return of investment, and have a guy doing the work and getting paid a decent return as well. So again, just think about how, and there's a lot of idle land that gets farmed around that, what's it worth? It's not worth much to them. Can you get it pretty cheap to graze and different feed sources and all sorts of things? So thinking about the model, technology, lots of opportunities in the cattle industry. We've kind of maybe behind, partly just how the production systems go, but we're not going to have, well, actually we do have self-steering cows, but we don't have the technology that has advanced in the grain side of things. But from a management point of view, cattle management, from genetics, efficiencies, there's all sorts of technology that I think can come along. And as we have more interest in the cattle industry, more investment, labor we're always going to need, and economic unit size drops, maybe at these kind of price levels and profitability levels on the cow-calf sector. We've been always talking about you need 200, 500, 800 cows to be feasible operation, but actually these kind of returns, maybe it will intrigue somebody to have a couple hundred cows because there's actual returns there. Just want to point out Canfac's price reporting real quick. We all our prices are voluntarily reported and collected. We work with industry and feedlots, but it's critical to the industry in terms of the government uses our data. When we talk about trade challenges, Canfac's data comes into that. We need data and price insurance program. Their fed cattle index is based off Canfac's data. If we don't have data, a lot of those programs can't exist. Cash trading's changed so much. I showed the feeder market volumes and contracting, all that changes. Feedlots have done the same and have been doing it a lot longer. So I guess just want to promote anybody who's selling cattle to please report prices, talk to me. Whether it's cows on our direct sales, cows to packing, we track all of that stuff. But fed cattle's big, and we also can share back information. And certain pieces we only share with people that provide us information. We've got an app on the iPhones that gives some of the price insurance and does Canadian price projections. And finally, last piece of my commercial, just Canfac's memberships are available. So all this information, a lot of it's available online or through, you can talk to us. But as long as you're a Canfac's member, we do weekly reports. So you get about 50 reports per year of all these cattle prices and little key topic areas from each week of the market that we're covering. So for cow-calf producers, it's as low as $150 a year. So it's great value, and I'm not biased at all. But anyways, no, I'd recommend. Talk to me, or you can contact my contact info if you have any information, and our website. So